Hi, thanks for taking the time to listen to Alternative Angles, a podcast series where our guests represent a wide range of expertise across the alternative investments landscape. I'm Steve Rosen, a retired Fidelity portfolio manager, and I'm your host for Alternative Angles. In each episode of this podcast series, we'll get to know the people who make investment decisions in complex alternative strategies that are increasingly becoming vital components of well-diversified multi-asset portfolios. In this episode of Alternative Angles, I chat with Bill Maclay, the senior portfolio manager and key business builder of Fidelity's high-yield real estate debt investing platform. Bill's been at the firm for more than 23 years, and he possesses a wealth of knowledge by virtue of managing the real estate debt team's strategies in both the public securities and private credit markets. The breadth of Bill's purview is more than we could cover in just one episode, so we deferred a discussion of public markets to another day, and in this conversation went deep into high-yielding private real estate lending. We pack a lot into our exchange, including trends in credit conditions and property market fundamentals, strategies Bill believes offer strong risk-adjusted returns, and his investment philosophy and approach. Bill concludes by describing the investment rationale and underwriting process for a loan his team closed on earlier this year. I'm particularly excited to share my conversation with Bill because he and I co-managed portfolios and worked together closely for more than 2 decades, and because he supports his contentions with data and he adds context with a historical perspective. And now, my conversation with Bill Maclay. Hey, Bill. It's good to see you, and thanks for joining me today on Alternative Angles.
Hi, Steve. Thanks for having me.
Before we jump into private real estate credit, could you take our listeners back to why you chose a career in commercial property and give us an overview of that career and the breadth of your responsibilities?
Absolutely. So I was always fascinated by buildings growing up, and I can remember as a kid, I had a lot of Legos, and I would try to build Lego skyscrapers and see how many stories tall I could make the building. And it turns out that there were 2 limiting factors. One was my height, which I solved with the help of standing on a chair. And the second limiting factor was I eventually ran out of Legos. I think I got close to 10 feet tall for my tallest Lego building. But I also really enjoyed finance in college. So combining buildings with finance as a real estate investor was really a perfect fit for me.
Sounds like you got your start in real estate in the construction side of the business. And so anyway, go ahead. I interrupted.
Oh, so I started my career at Clarion Partners on the acquisition team, where we were investing in commercial real estate on behalf of institutional investors. And then I joined Fidelity 23 years ago, and I've been part of the real estate debt group for the entire time. My role has evolved over time. So I've been an investor in both debt and equity, and both on the public as well as the private side. And I feel fortunate that Fidelity has a broad platform, and I was able to gain an experience in just about every form of real estate that we offer to investors. And today I manage all of our dedicated real estate debt funds, which includes our liquid strategies as well as our private lending strategies. You know, what's interesting and exciting is we at Fidelity are expanding our alts effort, but there's certain alts capabilities that we've been active in for quite some time. Real estate debt is one of them. Fidelity's real estate debt platform was formed about 30 years ago, and we were originally a buyer of the subordinate portion of RTC securitizations. And as the CMBS market evolved, we did set up dedicated high yield CMBS accounts, and from there expanded into really all forms of real estate securities, both on the debt and equity side. Then in 2007, we stood up our private lending strategy, and we've been active in the real estate private lending market for close to 2 decades. Our real estate private lending effort, we are originating the loans ourselves. So we have dedicated originators, underwriters, asset management. It does take a good amount of work to originate loans, so we have a really experienced team.
Yeah, I remember from working with you that I really appreciated all the great work that they did and the specialized skill set that they had. And I also know that the private team benefits from all the resources and flow of information that comes with being, part of the larger Fidelity. Could you talk to us a little bit about how that differentiates your team?
Yeah, one great thing about Fidelity is we have a broad platform. So we're investing in every flavor of commercial real estate on the public side and the private side. On the public side, that includes REIT equities, REIT bonds, CMBS. And on the private side, we are buying buildings and we are originating loans on commercial real estate. If there's something happening in commercial real estate markets, we are seeing it and we are analyzing it. But what I find is also really helpful is we have a steady flow of CEOs coming into Fidelity every day from just about every single industry. And those companies are users of commercial real estate. All of our meetings here at Fidelity are open. And what's great about that is I can go into a meeting and ask, say, a tech company, how are they thinking about their space needs, or a retailer, how they're thinking about their brick and mortar space versus selling through their e-commerce channel. And those are just a couple data points, but it's the aggregation of all those data points over time that really helps us understand changes in the underlying demand for commercial real estate. So all those great resources is just one of the reasons why I've been here at Fidelity for more than 2 decades.
Let's shift now from you and your platform and talk about what's going on in the private real estate markets. So to start out, could you lay out the landscape for the supply and demand for real estate debt capital?
Yeah, let's start with who the largest holders are of commercial real estate debt. So banks hold about 50% of the outstanding commercial real estate debt. GSEs like Freddie Mac and Fannie Mae hold about 17%. And then there's insurance companies and CMBS, each hold about 12%. But banks are the ones that have the largest exposure. So they're a really important piece of the commercial real estate ecosystem. And there's been plenty of headlines about how banks are lending less for commercial real estate. And that's mostly true. That is what we're seeing live in capital markets. You can also see it in the Senior Loan Officer Lending Survey that's done by the Federal Reserve, which shows the current time period has one of the highest percentages of banks tightening their lending standards for commercial real estate. There's only been a few other times in history that it's been this extreme. One was during COVID. That was a pretty brief period of time. Another was back during the global financial crisis in 2008. And then for the third example, you have to go all the way back to 1990 during the savings and loan crisis. So banks have tightened their lending standards and are looking to reduce their commercial real estate exposure. And there's really two main reasons for this. One is their shareholders are pushing them to reduce exposure, but regulators are also encouraging banks to reduce exposure as well.
I hadn't realized that this cycle's reduction in lending was approaching what we experienced during those crisis periods in the past. I think of the current reduction and pressure in bank lending as being more a problem for the regionals. Is that accurate?
Like most things in life, it's not uniform. So the exposure to commercial real estate does vary across all the banks. The largest banks have less exposure to commercial real estate than regional banks. And if we were to break up the commercial real estate exposure by bank sizes, what we would see is the very largest banks that are classified as globally systemic important banks are about 17% of the bank CRE exposure, while regional banks are 30%. So the large banks also benefit as they have a natural exit for their very large loans on trophy properties, and that's through the CMBS market. We are seeing loans refinanced off the balance sheets of money center banks into the CMBS market. These are high quality trophy properties that capital markets can easily absorb. So if you're an important client of a money center bank or you have access to the CMBS market, then you have decent access to capital. But for more modest sized borrowers that are clients of regional banks, they have less choices. What's also interesting is at the same time as this is there's approximately $2 trillion of commercial real estate debt that's maturing over the next 3 years. So there's definitely an imbalance between the need for debt capital and the supply for debt capital.
Yeah, well, to that point of imbalance, I know that from the market cycles we invested through together, those imbalances can lead to distress or to opportunities. And it sounds like the need for debt capital potentially creates opportunity, but other key pieces to factor in are property valuation and leverage. Could you give us some perspective on them?
Yeah, absolutely. So if we look at in the last 40 years, there's actually only been two other time periods that commercial real estate prices have experienced a decent sized drawdown that we've seen in the last 2 years. And those two other examples were during the global financial crisis back in 2008, and then uh, in the S&L crisis during the late 80s and 90s. And what's interesting is in both of those cases, overlending was an issue. And when I say overlending, what I mean is leverage in the market is too high. As an example, if we use a data set from Real Analytics, which is a real estate data provider, the average loan to value in commercial real estate debt was north of 70% back in 2007, going into the GFC. Post GFC, it reset lower and then actually continued to trend lower. Real estate lenders clearly did not want to get burned again. Now, over the last 5 years, that average loan to value using that same data set is only 60%, so materially lower. And that's good because it allows the plumbing for the financial system to be in good working order. And for the most part, that means that banks that think they're overexposed to commercial real estate can just lend less and let their current exposure drift down.
So, lower property values, lower leverage, that all sounds like a good setup going forward. But nonetheless, sentiment towards commercial real estate seems negative, with stories highlighting office building loan defaults. So there's a tension there. And Phil, I think I'm going to make you cringe because it reminds me of a literary illusion, and I know that when we work together, you would kind of shrug your shoulders or look aside when I pulled one out. But um, I got to appropriate Charles Dickens here, because the tension that you just described, I think, says that the headlines are harping on the winter of despair, but you seem to lay out an argument for the season of light. So, from a property fundamentals point of view, what is missed by those news stories?
Well, I realize that when people think about commercial real estate, they tend to think about office buildings, but it is worth noting that office buildings are only 15% of the overall commercial real estate market. And office buildings are absolutely in a challenging situation, but commercial real estate is comprised of many different property types with many different underlying demand drivers. Some of those other property types include warehouses, self storage, apartments, retail centers, and many more. And the underlying fundamentals away from office are actually quite good. So the occupancy rate for warehouses and apartments and even retail are all in the mid to high 90s and are either stable or increasing. And if you look at the property level cash flows, they're growing nicely for these property types. So the commercial real estate universe is actually a lot bigger and more diverse than what many people first think about.
Given that backdrop that you just laid out, what fits well for your private lending strategy?
We've lent on every single property type over the last 2 decades, but our focus is on property types that have structural tailwinds. And today, our focus property types include the housing portion of commercial real estate, which is comprised of apartments, single family rentals, and seniors housing.
What's the structural tailwind that you're referring to? I assume you mean the lack of adequate supply of housing in many markets. Is that the structural tailwind for housing?
Absolutely. We do
Okay.
have a structural housing shortage, and that creates a nice demand tailwind for any form of housing, really. But but we also like grocery anchored retail centers when we have a strong operator. We also like warehouses as the build out of the logistical network to bring packages to our home even faster is not done yet. And we like self storage. It's a great property type with sticky tenants, great margins, and very little capital expenditures.
Yeah, I remember from our investing that low capex was something that we were always looking for as we invested. But now on to maybe the opportunity. You're telling me that the supply of capital to real estate has contracted. That means reduced competition. So that's good for you as a lender. And property fundamentals, aside from office buildings, are in decent shape. So tell me how you're going after the opportunity that you lay out.
I think there's a really exciting opportunity to deploy capital. This is a chance for private capital to step in and fill the void left by banks. So the market share for private lenders could increase and the market share for banks could decrease. That is what happened in the corporate market. And so it wouldn't be so surprising for real estate to follow a similar pattern. I mentioned earlier there's a difference in commercial real estate exposure for large banks versus regional banks. The key piece of the market to fill is the middle market. That's the land of the regional bank. Regional banks accounted for about 9% of all commercial real estate loan originations back in 2011. By 2022, regional banks accounted for 29% of all commercial real estate originations. Now that's decreasing, and it would not be so surprising to see that continue to fall. So there's a decent size hole in financing for the middle market. And what's really exciting about the middle market in commercial real estate is there's so much real estate that falls into that size range.
Put some parameters or numbers around the middle market size range. Define that segment a little bit better.
When I say middle market, I'm thinking of properties with values of 50 to 150 million. And just to give you a sense of the depth of that market, if you look at transactions of commercial real estate over $50 million during the last 5 years, about 2/3 of the transaction volume was in that middle market segment of 50 to 150 million versus the higher end of the market of over 150 million. So the point there is there are a lot of buildings that will need financing that are in the middle market.
Tell us why you focused your strategy there, and I guess what are the advantages of playing in what seems to be a pretty big set of opportunities?
So we do find that the middle market is more fragmented and less competitive. As you scale in transaction size, other sources of capital start to come into play, such as Wall Street or the CMBS market. What is also nice about the middle market is the property types that are most present in that segment. If we were to look at that size range again of 50 to 150, what we see are apartment buildings, warehouses, self-storage, grocery anchored retail centers. Those are the property types that we're focused on as they have good on the ground fundamentals with rising rents and good occupancy. For properties that have values greater than $150 million, office buildings are actually a pretty big piece. And that makes sense when you think about what type of buildings are very large. Central business district office towers tend to be big buildings. I enjoy working in an office building, but I'm not so excited about financing them.
You've got this middle market approach. You lay out some good reasons for investing in it, and I know from our work experience together, there are several ways to go at it. Can you tell us about each and about how each of them might be a capital solution to meet a borrower's business plan?
So in high yield real estate lending, the majority of the time, the sponsor has a business plan to create additional value. A very common approach to real estate private lending is bridge lending. That's where a sponsor or borrower wants to reposition a property, so they need shorter term financings. Examples of a business plan might include renovating and upgrading a Class B apartment building into say a Class A to achieve higher rents. Another example could be repositioning a retail center to higher quality tenants that might pay a higher rental rate. The business plans usually consist of upgrading a property to achieve a higher rental rate, which should also increase the value of the building. The term is usually 2 years with 3 one-year extension options. So for a fully extended term of 5 years. One of the challenges with bridge lending is it is expensive financing. So the sponsor or the borrower wants to refinance that higher rate into a lower rate sooner than later. And if it's a light renovation, the sponsor might be done in 12 to 18 months. And the typical prepayment protection is about 18 months. So for projects that go well, you do get refinanced uh, right at that 18-month mark. If you're getting your money back after a year and a half, you need to be constantly originating just to keep up that current exposure. It's kind of like running on a treadmill. Um, when we do bridge lending, we work really hard to find ways to keep our loans outstanding longer to avoid that treadmill effect. And one of those ways is the type of sponsor we want to lend to. A typical sponsor or borrower for us is a large regional developer or owner. And what we like about that type of sponsor is they should be an experienced owner with an organizational structure, and they really know their market and their property. And what they want from a lender is a fair deal. And what we've noticed is those loans tend to stay out longer. They want to make their money from owning the right assets and managing them well. And they're less focused on financial engineering. Another way we find to keep our loans outstanding is longer, is originating more than just bridge loans. So construction lending is also a key piece of the market. We are fans of construction lending. What we've found is that when we partner with a experienced developer, we can reduce the construction risk. And when the project is complete, we have the newest building in the market, well below replacement cost. For construction, we're mainly focused on multifamily, which is apartments and pre-leased warehouses. We find it easier to underwrite those assets versus, say, taking speculative lease-up risk of an office building. We're also not fans, again, of office buildings. Now, the other thing we like about construction lending is it does tend to stay out longer. It does take roughly 2 years to build an apartment building, and then it takes another 12 to 18 months to lease it up. So construction loans tend to stay out longer than bridge loans.
Whether it's bridge lending or construction loans, these are first mortgages. And tell us what the spread is typically in today's market for those types of financings.
Yeah, you're right. Those are first liens. So a first lien bridge loan or a construction loan typically are floating rate, and they have a credit spread that generally ranges between 300 to 400 basis points over SOFR. There's actually one more type of loan that I also wanted to mention, and that's gap financing. This is a chance to finance stabilized properties. So a borrower may be looking to refinance an asset, but first mortgage proceeds are lower due to the current environment. And say a bank is willing to provide a new first mortgage, but the prior mortgage had a 70% loan to value, and the bank is only willing to provide a new loan at 50% loan to value. This is where subordinate financing and some new equity capital can come in and fill that gap. It's possible we could see a need for a good amount of gap financing in the coming years due to the variety of factors that we've talked about. Again, commercial real estate values are down from a few years ago. Banks are lending less, and lending standards have tightened. And with $2 trillion maturing over the next 3 years, it seems like gap financing should be needed more today than in the past. And you had asked about rate that we're seeing for gap financing. We're seeing yields of around 15% in the marketplace.
Okay, pretty attractive. But you said a minute ago that bridge and construction loans typically have that spread of 300 to 400 over SOFR, but I know you're shooting for double-digit yields, as illustrated by what you're doing with the gap financing. So can you explain to our listeners how that 300 to 400 spread range squares with the higher yields that you're trying to achieve?
Yeah, that's an important point. So an important side of high yield real estate lending is the financing side of the business, because as you point out, investors generally expect a return in the low double digits. But as we were just talking about, a bridge loan only has a credit spread of 300 to 400 basis points. And even with SOFR elevated, you don't have quite enough yield. And the way you get there is leverage. And what I mean by that is the high yield lender needs to somehow have exposure to the junior portion of the debt, and a lower cost of capital needs to have exposure to the senior portion of debt. And there's really three main ways to achieve this. They are using a line of credit, CLO financing, or using a mezzanine loan structure. For each of those ways, the leverage at the asset level could be the same, but the method of creating that subordinate position is different. So just to unpack that a little more, for using a line of credit, you would start by, say, originating a first mortgage at a 70% loan to value at a spread, as we talked about, SOFR plus 400, let's say. Then you go to a credit line provider, which is typically a money center bank, and pledge that loan that you originated as collateral and borrow against it. It might be an advance rate of, say, 75% at a rate of SOFR plus 200. So the provider of the credit line has the senior exposure, and the high yield lender has the subordinate exposure, and will earn a mid-teens return on that levered position. So through financial leverage, you've created a synthetic subordinate position that is high yielding. Now, one of the risks with this strategy is you could have a margin call, or you may need to have liquidity to remove a loan from the credit facility for a variety of reasons, such as, say, a workout scenario. One benefit, though, is this method is efficient and does work for higher volumes of lending. A second way is to use a CLO as a financing vehicle. So the high yield lender would accumulate loans that were originated, again, at 70% loan to values, and then they would deposit those loans into a trust. That trust is taken to a rating agency that rates the different tranches or classes based on the seniority and the structure, and then assigns a rating of, say, AAA all the way down to single B or unrated. The senior portion in the structure are investment grade classes and are sold to bond investors. And the high yield lender retains the subordinate position that includes the below investment grade bonds. So it's the capital markets or the bond investors that have exposure to the senior portion, and the high yield lender, again, has that subordinate position. And the high yield lender will earn a similar yield that I mentioned earlier, the mid-teens for its subordinate position. An advantage of this method is you have structural leverage. So that really limits the risk of margin calls from a line provider, but a risk that you are taking is you're relying on capital markets execution to distribute as well as price those senior bonds.
You've explained method one, method two, or there's method three. You had mentioned that there's also mezz financing. So maybe you could talk about that for a minute.
Yeah, a third way is to partner with a bank or insurance company that has a lower cost of capital, and they just originate a low levered first mortgage at a 50% loan to value, and then the high yield lender simultaneously originates the next 20% of the capitalization as a mezzanine loan, bringing that total loan to value to 70% or the same as those prior examples. So the leverage point at the asset level is the same as the other ways, but the method is a structural leverage and is created at the time of origination. This eliminates the risk of margin calls. It also eliminates the risk of capital markets execution. So each of these methods definitely have benefits and drawbacks. My personal preference is to use the mezzanine loan structure, as there's no financial leverage. This is a structural leverage, which means you can't get called out during times of volatility. And it's during those times of volatility that we want to focus on deploying capital and not worry about the risk of a margin call. Now, to be fair, though, the drawback is it's more difficult to do in high volume.
Okay, but nonetheless, in your view, the mezz structure is the preferred route because you can put to bed the risk of a margin call. Probably helps you sleep a little better at night. That's good. Don't have to worry about losing your collateral. But let's take another step forward and talk about how you're going to create alpha with this appropriate margin of safety.
Yeah, there's There are 5 things that I think about for creating alpha or excess return. The first is, as with all debt investments, you can only get back par. So credit is most important. We have managed real estate debt funds through many cycles, including all the way back to LTCM, the bursting of the internet bubble in the early 2000s, the great global financial crisis, COVID, and certainly today. So understanding credit risk is deeply embedded in our culture. The second way we think about creating alpha or excess return is being very selective. So the top of our funnel is very wide to start. So we're getting all the packages from the mortgage brokers. We have many, many direct relationships with sponsors. We're coming through billions of dollars of opportunities, but we say no a lot. Our general goal is to focus on our very best ideas. And each time we do a loan, we're very excited by the opportunity. The third point I want to make is we look for portions of the market that are less competitive. So sponsors looking for larger loans do have more options. We talked about that. That includes the CMBS market, money center banks, insurance companies. And we've been talking about how the middle market has a big hole to fill. We think the middle market is less efficient, and we really like that niche. The fourth is keeping our loans outstanding for as long as possible. Again, we talked about this. We work hard to put as much prepayment protection in as we can. We mix different types of loans beyond just bridge lending. We also look for sponsors that are less that are focused on the real estate rather than the financial engineering. And then the last point I want to make is we avoid fund level risks. What I mean by that is I'll put financial leverage in that category. I think it's really important not to have too much fund level leverage, as it could create liquidity risks. During the global financial crisis, we saw funds get into trouble both from loans defaulting, but also from having their financing lines pulled on them.
Okay, so it sounds like you're building in protections, doing your due diligence, yet the yield on your investments is pretty high. So how are you able to offer a high yielding loan that's compelling to an experienced borrower sponsor with a track record, with a good business plan and quality real estate?
What I think might be helpful is if we used a recent transaction as an example. I mentioned we like grocery anchored retail centers with strong operators. And so in this example, the sponsor acquired a grocery anchored retail center in a suburb of Chicago. And their business plan was to upgrade that property as well as the quality of the rent roll. The property has what I would consider an A-plus location. It's in a town with many surrounding single-family rooftops. The town has a very high average household income, and there aren't really any other retail centers around. So dense area means lots of shoppers. High average household income means plenty of disposable income. And no other retail centers in the area means limited competition. All that sounds great, but this sponsor thought that this property was undermanaged and it had a lot of local tenants that were not doing the greatest and restaurants that were a little bit underutilized by the neighborhood. The grocery store did really well. It appeared that the neighborhood people would just go and get their groceries, but not much else. And this sponsor is a really good retail operator. And this center has all the right characteristics and has even more potential. The great retail centers are places where people want to be and enjoy spending time at, and this property definitely could be that. So this sponsor has excellent relationships with retailers, and they had several national luxury brand name tenants that wanted to move into the center, and the sponsor also had a plan to bring some restaurants in that are a much better fit for the local residents. Now, to do this, they needed additional capital to fund a renovation, to improve the curb appeal, and bring in those new tenants that are the luxury tenants. And it's not cheap to create high quality space. So we were able to provide them with financing that was allow them to move their business plan forward.
Yeah, it sounds like you really had to believe the business plan and sort of see through at the outset what this property could become in order to make that loan. So I guess maybe that's the others couldn't, and that's what allowed you to step in and get presumably a nice yield for your capital. So how did this opportunity come to you guys, and what did the due diligence look like to make you comfortable?
Yeah, so we already had a relationship with this sponsor as we've financed them for other similar projects in the past. So we were able, in this case, to directly negotiate the deal. During that process, our team went through our normal diligence process of fully underwriting the asset, sitting down with the sponsor and going through the business plan, including understanding which new tenants may come in, which tenants might move to a different spot in the center, and understanding the capital expenditures to improve the property's curb appeal. We walked the asset many times with the sponsor. We also underwrote the market and all the competitive properties. And even though this was a repeat sponsor, we still ran the full background checks of the sponsor.
So what were the tell me about the risks, and from your point of view, given the due diligence that you did, and what were the economics?
Two main risks that we were thinking about. One was on the construction cost side, and then the other was risk associated with leasing and signing up new tenants at higher rates. Now, I mentioned this is a repeat sponsor. They've done this in the past, and we've seen them execute on the construction side. And we thoroughly went through the budget with them. And even after that, we still put in a nice contingency line item just to add buffers. So we felt really good on the construction side. On the leasing side, the sponsor already had a couple lead tenants, but there was still additional space that needed to be leased up, and they wanted to wait till the project had matured before thinking about the new restaurants. So we underwrote the depth of the market, and we've seen this sponsor successfully execute and lease up space. So we had conviction in the business plan. Our last dollar of financing came out to about a 70% loan to cost, so modest leverage with a nice equity cushion. And we had a coupon in the mid-teens. So I think that's a pretty attractive rate for something that we're pretty excited about. This sponsor's a long-term owner. So when the business plan is complete, they'll have re-tenanted the property, completed their capital expenditure plan. At that point in time, they will probably look to refinance us out and pay us off.
Yeah, sounds like a compelling opportunity. You have exhausted my questions, so I think our episode on private lending is done. I really want to thank you for your time. This was you shared a lot of great knowledge. I wish I had a Lego hard hat to give you as a parting gift. Again, I look forward to having you back on Alternative Angles another time.
Excellent. Thanks for having me, Steve.
Important disclosure. This podcast is intended for institutional investor and investment professional use only. Information provided in and presentation of this document are for informational and educational purposes only and are not a recommendation to take any particular action or any action at all, nor an offer or solicitation to buy or sell any securities or services presented. It is not investment advice. Fidelity does not provide legal or tax advice. Before making any investment decisions, you should consult with your own professional advisors and take into account all of the particular facts and circumstances of your individual situation. Fidelity and its representatives may have a conflict of interest in the products or services mentioned in these materials because they have a financial interest in them and receive compensation, directly or indirectly, in connection with the management, distribution, and/or servicing of these products or services, including Fidelity funds, certain third-party funds and products, and certain investment services. Views expressed are as of November 2024 and may change based on market and other conditions. Unless otherwise noted, the opinions provided are those of the speakers and not necessarily those of Fidelity Investments or its affiliates. Fidelity does not assume any duty to update any of the information. Some of this information is forward-looking and is subject to change. Past performance is no guarantee of future results. Investment results cannot be predicted or projected. Information provided herein is for informational purposes only and is not a recommendation or an offer or solicitation to buy or sell any security or for any investment advisory service. Alternative investments may not be suitable for all investors and are not intended to be a complete investment program. Alternatives may be relatively illiquid. It may be difficult to determine the current market value of the asset, and there may be limited historical risk and return data. Costs of purchase and sale may be relatively high. A high degree of investment analysis may be required before investing. Fidelity Investments and Institutional Investor are not affiliated. Fidelity Investments provides investment products through Fidelity Distributors Company LLC and clearing, custody, or other brokerage services through National Financial Services LLC or Fidelity Brokerage Services LLC, members NYSEC, 2024 FMR LLC. All rights reserved. 11742007.1.0